Hi everyone, welcome back to the channel. Today, we all know the news. Recession is coming. It's doom and gloom. After what happened last week, it looks like there's no end in sight. Start of day Monday, stocks markets are down 7%. And some are saying that recession is just inevitable. This morning, the market even stopped trading for 15 minutes because there were so many losses. It fell so much. Stop, we're done for the day, can't trade anymore. And when the market resumed, of course, the losses resumed as well. Now, on top of that, Robinhood crashed for the third time. Second major trading day, Robinhood goes down. So it's bad news on top of bad news on top of bad news. Today, I'll give you some pointers to kind of guide you and talk about some things that you definitely should not do in the midst of all this panic and uncertainty. Let's get into it. Number one, if you have any type of investment account, most commonly 401ks, don't fire sales, sell everything, dump everything, stop contributing unless you're close to retirement. If you are close to retirement, you might want to consider speaking with an advisor, someone that knows your situation better, since you are closer to retirement, so you don't really have the luxury of waiting another 10, 20 years for the market to go back up, for your money to go up. You're going to need that money in 3, 4, 5 years. So you want to try to preserve as much as you can. One thing about target funds, if your money is in a target fund, they're usually designed to be more conservative the closer you are to retirement age. So if your money is in some type of fund like that, it will be in more conservative investments, but still take a look at what those funds are. And if you are concerned, speak to an advisor on how you should proceed. Another reason why you wouldn't shift investments, pull out completely, is if your company doesn't offer many options in an employer or company sponsored plans, for example, 401ks, if there's only a couple funds indexes in there for you to choose from. Nothing good to weather this volatility. You might look into starting an individual retirement account. IRAs that are not associated with an employer, you can start this, put the money in, save up for retirement. This will give you a lot more options to choose from for where you want to put your money. If you are further away from retirement, you have 20 or 30 years, 40 to 50 years, you just started working, you should focus on your investment goals and invest consistently and continue those contributions. Especially if your company or employer provides some sort of retirement 401k match. This could sometimes be 4% up to 7%, 10% match. This extra money, free money from your employer just for putting money into your retirement account, can help weather some losses. You're getting this money for free. Obviously, you do hope to see some gains on that money, but this can help cushion any losses that you will experience from the marketplace. And if you are contributing more and you want to kind of think about contributing less just because you're scared of losing more money, if that's one thing you want to do, make sure that you're not going under that employer match. You always want to maximize the amount of money your company is giving you for free just for putting money into your retirement. This, of course, assuming that your company doesn't straight up just stop offering matches. We saw this back in the 2008 Great Recession. Some companies got so bad that they stopped offering retirement account matches. So if this does happen, you might also want to reconsider your option. I will say, if you are scared of losing a lot of money, you're looking at your account, you're down 10, 15%, you can look into rebalancing or shifting some of that money into some safer assets just for the time being. On the other hand, if you don't really want to stress yourself out about what's going on every single day, keeping your money where it is, if it's been working for you, target date funds or things that you've selected yourself, should be fine. Over the long run, 30 to 40 years, we see that the markets usually go back up. So as long as you're contributing consistently, you should be fine most of the time over the long run. Especially for younger people, people that are just out of college, starting their first job, only have a couple of years of work experience. You may not have as much money in your retirement account as opposed to someone who's 5 years away from retirement. They've worked 40 years. So a 10 to 20% loss now, numbers wise, isn't as big as someone who has couple million dollars in their retirement account. If you're just starting out, you might have a couple thousand, 20, 50,000. The loss numbers will be less. And if you just contribute, and if you're able to keep your job and contribute for the next 40 years, you should be okay. And like I mentioned before, the market is pretty consistent at giving us long-term gains. The historical average for stock returns is about 10% year over year. This number can fluctuate and go up and down between each year, but in the long run, we're seeing 8 to 10% gain. Now, this is not to say 100% accurate prediction that the stock market will always go up in the long term. This is just from the past, from the Great Depression, the recession in '08. From what we've seen, the stock market usually bounces back some amount of time afterwards. There's no guarantee, but from history, we usually see that markets will go back up over time. And also, instead of completely wiping out, pulling your money out of your 401k or retirement account, you should also focus on protecting your short-term investments. If you had stocks saved up just for short-term investing, you want that money now, you're looking to get some gains, and you can't afford to lose it, I would consider shifting this money into a high-interest savings account or some safer options for you instead of the stock market, just because it's been so volatile and we don't know when the end will be. And since we don't know where rock bottom will be, if you have any type of investing or retirement account, we've heard a lot of people say dollar cost average or way down, which means just buy consistently. As it goes down, you'll be getting, I guess you could call it a discount on your way down. Apple stock, you're getting it at 300, 250, 225, not spending all your money at once, but averaging the cost as it comes down. Think of it as a sale. And once it goes back up, you'll have accumulated a certain amount of this stock or equities, and you'll be able to see those gains as they go up. This strategy obviously works in the long term if you're not looking into those quick short profits. You're thinking, okay, we're not at the bottom yet. We may be at the bottom. I don't know when we're going to hit the bottom, but I know it's going to go down. I know things are going to go back up. So 5 years from now, we see that I'll get 10 shares of Apple stock, on average $250 now, but in 5-10 years, I think it's going to go up to $300, $400. You get that now, hold it for the long term, and then sell it off later on when you can get those profits. This buy as you go approach definitely depends a lot on your own research. What kinds of stocks do you think are going down, and if they have an opportunity to go up, or do you think if it goes down, it's just going to straight up bankrupt? I do want to say a word of caution. We've just come out of a very long bull run. Stocks, other markets have been at all-time highs back in early 2020. So some people have been saying that these stocks have been overvalued for some time now. So as the crash starts to begin, we kind of want to think about where we think those stocks are correctly valued and where the fall actually begins. Because if we think something was overvalued in January, maybe $20 over what it was, if it crashes $20 to where it should be valued or where people think it should be valued, we're at that neutral per se. So anything after that would kind of be the discount that you're looking for. So if a stock is overvalued, it crashes and it's just where it's supposed to be, even if we go down and come back up, it might take a long while before it goes all the way back up to where that overvalued price was. So do your research, kind of see what's out there, what was overvalued, how much has it crashed, how much do you think it could go back up for your long-term option. To give some historical context, it took about 3 or 4 years after the 2008 Great Recession for stocks to get back up to where they were before the crash. So this is definitely a long-term option if you want to hold and see those profits 5-6 years from now. The second thing you don't want to do is very risky and reckless speculation, especially right now when the stock market is so volatile. Now, if you do have some extra money and you are okay with losing it, a lot of people have been seeing this as a good opportunity to make some money off of the huge swings that we're seeing in the market. But if you don't have that money to lose and you just fear of missing out, You don't want to lose all those profits that everyone else is getting. Don't do these things. Don't short stocks. Don't buy risky options, put or call options, day trading. Risky investments like that are bound to lose you money if you don't know what you're doing, and especially if you can't afford to lose that money. If you are doing these things such as buying or selling options, you want to keep in mind that it's a very volatile market, so the volatility in these options contracts are very high. And also, there's been an influx of people wanting to get in on this game. So if you're trying to gamble your money, just be aware that a lot of the premiums on these option contracts are pretty high. So even if the market moves in a certain direction, you might not realize the profits or gains that you're expecting. I mentioned this in an earlier video. Do your research. There's a lot of helpful websites online for you to get a grasp of what you're looking at and to help you make smart decisions when making these option plays. With these risky speculation and options trading, you also want to think of the psychology and take that into account. How much are you willing to lose and how much are you willing to gain and be satisfied with it? For me, I like to set kind of a goal for myself. Maybe if I'm reaching, for example, if I'm buying 2 contracts and I'm already up 300%, maybe I can sell one off, keep those profits, and the other one, if it keeps on going up, that's great. I gain more money. But for some reason, if it just crashes down, that contract expires worthless. I still have sold one of them, kept those gains, have some amount of profit as opposed to losing all my. Have an idea of what you're willing to gain, how much, what your goal is in the end. And if you're willing to hold through the bad days just to be able to see those gains on the other side. Last week, the market was going up and down, up and down. So if you got scared, the market's going down, you're selling, the next day it's going up, you're getting that profit. So just have a plan before you get in so you can take some of the emotions out of it and just figure it out based on your plan. The third and last thing you don't want to do during economic downturn or recession is to take on more debt. Given your individual economic situation, this might not be the best time to take on a new car loan or a new home loan or to have some big ticket purchase that you've been waiting for. Save that money, hold on to it. Make sure you're building up an emergency fund, especially in a lot of the service, tourism industries. We might be seeing furloughs or temporary work stoppages as companies begin to see that there's less demand, so they don't need to be as fully staffed as they were if the economy was going great. Everyone's going out, eating, traveling. Now, depending on your situation, some factors you want to consider is your income, your job security, how much money you have saved away if you really need the item. For some who are in a good, stable situation, have a lot of money saved up, this could be a good time to make some purchases as interest rates are dropping. But for others, definitely not a good time to take on new debt. So your mileage will vary. If you have any questions, speak to a professional investment advisor who knows your situation a little bit better. But to wrap this up, I would definitely say to keep an emergency fund in just in case this recession or downturn lasts longer than we expect. You want to be prepared ahead of time as opposed to reacting and scrambling after the fact and being forced to take on debt or loans that you could have prevented if you had just planned ahead of time. But thanks for watching. Once again, if you have any comments, let me know down in the comment section below what you're doing, any plans that you've taken on during these crazy times. But stay subscribed for more updates, investing, finance, insurance. Thanks for your time. Thanks for watching. Peace out.